Stock of the day though, let's kick off and get straight into it because it is earnings season. There's a lot to talk about. Stock of the day, Scentre Group, the Westfield owners here in Australia, has recorded 41.8% drop in its annual statutory profit to 174.9 million, booking an unrealised $1 billion write-down on the value of its shopping centre portfolio. Despite the dip, company continues to flag another year of earnings growth despite elevated interest rates weighing on consumers and pushing up its debt costs. Funds from operations rose by 5.2% to just over $1 billion. And joining us now to run through it all is Elliott Rusanow via Skype, the Chief Executive of Scentre Group. Elliott, thanks for joining us. Met expectations in the market. What were the highlights for you?
Well, thank you, David, for having me on your program today. We're really pleased with the result that we've been able to deliver for 2023. As you noted, our profit, FFO, which is a measure of our cash profit, rose 5.2%, the higher end of our guidance range that we had set this time last year. And that was driven by a net operating income growth at the property level of 8.8%. And so we've been able to, as you rightly pointed out, weather the increased costs of interest or funding costs and still deliver 5.2% growth in earnings for our security holders. And we're able to guide to growth in 2024, unique for our sector, actually, of growth in 2024, of earnings growth of between 3 to 5.4% for that year coming. So we're really confident in the business, in our strategy of driving more customers to our destinations. We were able to achieve 512 million customer visits during 2023. That's on average 10 million people per week. And as a consequence of that, we were able to generate for our business partners sales of $28.4 billion, which has meant that our business partners have increased their demand to take space with us. Our occupancy has increased to 99.2%. Our leases have increased on average, rents have increased on average by 7.5%. New leases are being signed for the year at 3.1% increases on top of that. For the second 6 months, that actually accelerated to 3.6%. So we've increased occupancy, there's less available space, more people are coming, more businesses are demanding or wanting to take space with us. And that's leading us to have earnings growth for the year past and for the year coming.
So has foot traffic returned to pre-COVID times? And how do you measure that? I remember a while ago you used to have that audited, didn't you? How do you measure foot traffic now?
Well, we have a lot of door counters, CCTVs, many forms of technology that do measure foot traffic. It is something that we focus heavily on. We invest significant amounts of technology into understanding that because that's a key driver for our business. It's what we do is to drive people into our destinations. The way we do that is by obviously activating our destinations. We did take the view last year that with the increased cost of living pressures that you did highlight in your opening remarks, that fundamental to our business is that we offer free entertainment. We're a place that costs nothing to come to. And so we undertook a deliberate strategy of giving people a reason to come to our destinations and spend time with us. We partnered with leading brands, Disney, Live Nation, a number of local activations which do give people a reason to come, and they have come. And so we are seeing the benefits of that. And customer traffic continues to increase. So in the first 7 weeks of this year, we've already welcomed 70 million customer visits. So what we're seeing is that the conditions that we saw in terms of customer visitations last year are continuing into 2024. Sales for the month of January are higher than January 2023. And in fact, the sales that are being generated by our business partners at our destinations continue to outstrip the reported numbers from the ABS. So we are, as a business, and our business partners are outperforming consumption more generally in the economy.
Getting lots of IR in real life visits from shoppers. Tell me about your online arm of the business. you're actually shutting that down. Now that sort of goes against the trend of virtually every other retailer. What's happened there?
Well, I think the first point is that we're not a retailer. What we are is that we're a platform for businesses to connect with customers. And part of the offer that we do provide is an online presence which provides information and searchability for potential customers to research before they come to our destinations and understand what's going on in our destinations. What we also do, which we are focused heavily on, is our membership platform. And we announced today that our membership platform, which is enabled through an app using mobile technology, now has 3.8 million members. That was an increase of 640,000 members during the year. In fact, the membership platform is only 4 years old, and in 4 years, we've already attracted 3.8 million members. And we see that as being a growth opportunity for us because it allows us to have a more direct communication with our customer, which then facilitates how we curate the destinations for that customer, but then also what businesses are aligned to that curation. And so the deeper understanding we get from our customers is very important to us, as well as growing the number of customers who are members on that platform. So I would say that we're pivoting our online presence towards a shift to our membership platform because of the benefits that gives us with respect to driving more customer visits and producing more potential for businesses to partner with us.
Yep. Okay. Run through the property revaluations for us. Oh, I think we just lost Elliot there. Seems to have frozen and dropped out, but I think we got all of the information that we needed. Elliot Rusanow, the Chief Executive of Scentre Group, our stock of the day. Let's bring in the panel. Henry Jennings from Marcus Today joins us. Henry, what did you think of Scentre Group in the update?
Well, I've got to say, Kochie, Westfield is a Goliath, isn't it? Let's face it, it's a behemoth in Australian shopping centres. It's pretty impressive. You know, that write-down, I'm not really sure at the end of the day, you know, it's unrealised valuation write-down. So I'm not sure anyone really cares, to be honest, because at the end of the day, it's not like they're going to sell a Westfield shopping centre to somebody else. So those movements up and down don't really have a big effect. At the end of the day, you know, they got 99.2% occupancy, rent increases around 7.5%, and you know, everything looks good. It is a destination. It is becoming, you know, they're obviously adding value in terms of entertainment and dining, etc. So it has become a destination, and we've seen in the last week or so in terms of corporate retail profitability, you know, there's still people out there spending a lot of money in retail. I mean, it does depend on which retailer you are. Kathmandu, obviously, not quite such a success story as it has been in the past, but certainly, you know, the footfall traffic is good. Everything is good about this. It is a function to some extent of interest rates, and those REITs do tend to move in tandem, or inverse, I guess, with bond yields. So the higher the bond yield, the more the REITs come under some pressure. But at the moment, you know, at $3.04, I think brokers have got a target $3.30, $3.40. I'm sure they're going to warm to this result. We should see this one pick back up. They're safe. I mean, I was going to say safe as houses, but they're safe as Westfield. Let's face it. They are. You know, it's tangible. You can see it. You can walk around them. It's a good experience in the main. So there's nothing to dislike about this one.
Okay. So would you have it to buy at these levels, or it's a safe hold?
I think so.
Okay.
I think it's a buy at these levels. Okay. You know, if we do see rate cuts come, that's obviously going to help the economy, help traffic. You know, rental. They've got the power, haven't they? Let's face it. I'm paraphrasing a song. They've got the power. They can really, you know, you own 42 Westfield centres around Australia. You have that pricing power, don't you?
Yep, absolutely.
It's not unlike Woolies.
Yep. Yeah, say no more. Let's bring in Andrew Weiland onto the panel from DP Wealth Advisory. Andrew, what was your view on Scentre?
G'day, Koshy. G'day, Henry. Look, it was a vanilla result. No surprises. The market doesn't like surprises. Again, referencing Woolies and Mr. Banducci leaving suddenly. Markets don't take that news well at all. Whereas the centre result was certainly a pretty good result. As Henry said, I sort of came in at the tail end of Henry's point relating to it being a destination. 500 million people a year visit, well, 500 million visits a year, I should say, to the 42 Westfield centres across Australia and New Zealand. So certainly they're doing all the right stuff. 99% occupancy. But I'm going to say, Koshy, you've got to look at an ETF. Probably the one to think about would be VAP from Vanguard,
Right.
and it literally just tracks the top 29 REITs, including SCG. I do like the ticker, if nothing else, and it's up around. I'm going from memory here. It's up around 13% over the last 6 months, and up 8% over the last month. To Henry's point, because there's a view that interest rates are turning, and that these interest rate sensitive ones. But Koshy, is it a buy? Well, we'd have to start off the call with a double buy, wouldn't we? So
Yes,
we'll stick
why
a buy
not?
on this.
Excellent. All right.